जी अस्सलाम वालेकुम अस्सलाम वालेकुम Hussain Qazi here, your facilitator for SBR March 21 examination. Bismillah ar-Rahman ar-Rahim. Assalamu alaikum everyone. We people are here for the purpose of the revision session organized by the ACCA body, and I am the facilitator. I am your facilitator, Hussain Qazi. I hope you people are getting the voice very precisely, very clear, and the screen visualization also very clear. Screen visualization also clear. If the WhatsApp group is full, I will share the another one. I will share the another one during the break time. Don't worry. I will share another one during the break time. So focus on the session right now. Okay, so candidates, now today's topic about financial instrument. The topic about the financial instrument, IFRS 9, financial instrument, as well IS 32 and IFRS 7 as well. Our main focus area today to discuss about the financial instrument, and you know very well that the theme of our particular session, it's SBR 360. The theme of particular session, it's about SBR 360. So if we are discussing the topic financial instrument, so we will cover inshallah ta'ala the knowledge, if Allah willing, knowledge of the topic, connect with the ethics, connect with performance measurement. With respect to current development, I will share a video after the session, and I will try my best to cover also with the conceptual framework. I will try my best, otherwise I will share you some material related to this. So that is what SBR 360. We will cover the topic like this. So candidates, I know that this topic, you people are facing very much trouble with respect to this topic, and I hope that you people already covered with your regular course about this topic. We are just refreshing this topic. So because of that, only 9 to 10 days remaining the paper, and you people are worried about that, how to revise this particular topic, how to cope the situation accordingly. So that's why I have chosen this topic at that moment. What I personally think, for March 21 and the timing, that's the 23rd Feb, this topic revision is very critical right now, including the paper aspects. I will discuss the paper context as well. So I strongly suggest to you that focus on my session, plus focus on my notes. I don't think so that other than this notes, you need to go anywhere for the March 21 exams. That is more than enough. So this is more than enough. That is more than enough. So I hope that you people are getting the voice very precisely, very clear from my side. Okay, let's start the particular topic. That is the point of the financial instrument. Let's start. So number one, what is about the financial instrument? Number one, what is the meaning of the financial instrument? The financial instrument, quick matter. That's important. You people already have the notes. I have already shared on the WhatsApp. And please, ACCA body, ACCA management, can you please share the notes on the platform? At the handout section, it's already available. You can just pick the notes from the handout section of this particular forum. Okay, let's start. Let's start, candidates. Let's start. Number one, the most important thing. What is financial instrument? What is financial instrument? Financial instrument is actually a contract between two parts. So it's a contract between two parts. That's important. That is important. So financial instrument is actually about contract between two parties. At one side, that is financial asset, another side, financial liability. Or at one side, the financial asset, another side, the equity instrument. So the important thing is that we have to cover the point. What is the meaning of financial asset? And how to report financial asset in the financial statement. What is the meaning of financial liability and how to report the financial liability in the financial statement? What is the meaning of equity instrument and how to report the equity instrument in the financial statement? Candidates, the very important thing you have to consider at this moment. Number one, the term asset. Any asset any asset which meets the definition of financial asset is called the financial asset. Meets the definition of the financial asset, that's called financial asset. And which do not meet the financial asset definition, that is called non-financial asset. So don't worry about that. What is the meaning of non-financial asset? The term non-financial asset just within the scope of IFRS 9, just a terminology. For example, property, plant, equipment. Let's suppose I'm saying that property, plant, equipment not meeting the definition of the financial asset. That means it's a non-financial asset. Stocks, inventory, it's not the financial asset. That's called non-financial asset. So if in this standard, sometimes we use the term non-financial asset, don't confuse. Same case with respect to the financial liability. The liability which meets the definition of financial liability called financial liability. Other than that, non-financial liability. For example, deferred income. For example, tax payables. So don't worry, the term non-financial liability. Okay, so one by one we will discuss the thing. First, we will discuss the thing financial asset. Discuss the. It's not about discuss. It's about revision. Number one, financial asset. Whenever you study the topic of the financial asset, initially, you have to develop a mind that what are financial assets. So very basic definition that should be in your mind, that what are the financial assets? That is contractual right to receive cash flow. The very initial basic definition of the financial asset, it's contractual right to receive cash flow. Three things. It's very simple about the financial asset. Number one, cash is financial asset. Contractual right to receive cash flow. Contractual right to receive cash flow, financial asset. Investment in equity share, financial asset. Further, more complex definition exists, but these three are very simple. Whenever you need to explain the term financial asset, you can just pick a basic term, contractual right to receive cash flow. More details are investment equity instrument, derivatives, but later on. Okay. So the important thing is that in this accounting standard, the assets which meets the definition of the financial asset. For example, contractual right to receive cash flow. For example, cash. For example, investment in shares. And more example, let's say the derivatives. Whatever the derivatives is, I will discuss later. Derivatives, where the situation is favorable. FAB, favorable. That is all the financial asset. Let's suppose these four items, these four statement, mark my words, these four future expected benefits or benefits belongs to asset, that's called financial asset. But the question is that, when we will recognize any financial asset, or I must say that if some assets are financial asset, we have to obey the rules of the accounting with IFRS 9. If asset qualify for the definition of financial asset, then all the accounting aspects now have to meet with respect to IFRS 9. Number one, if the asset is financial asset, when to recognize? The financial asset will recognize when the entity becomes a party. For example, you purchase the derivatives. Don't wait for the settlement of the derivative. Once you part of the contract of the derivative recorded, that's all. If I say that contractual right to receive cash flow, for example, loan receivable. For example, loan receivable, contractual right to receive. You are a bank, you provide me a loan. You record loan receivable. You made investment in bonds. Investment in bonds. You have invested in the bonds. Contractual right to receive cash flow. So whenever you purchase the bond, whenever you hand over the loan to anyone, it's become the part of contract. You have to record it. Number one. Okay. So financial asset, when to recognize, when become the part of the contract. Number three, at what value should be recorded? Value means measurement. Accounting standard says that we will tell you how to classify and measure. Do remember, classification must be done at initial recognition. At initial recognition, you have to classify, you have to designate the classification. IFRS 9 says that IFRS 9, financial asset must be classified as fair value, that's P&L, fair value through OCI. Other one is fair value OCI. That's irrevocable election. Amortized cost method means book value method. Now, the simplified format. But hold it. You have to quick review. Whenever you initially recognize any financial asset, so initial recognition, that should be at fair value and adjust with the transaction cost. If fair value through P&L, transaction cost immediately charged to the P&L. If fair value through OCI, transaction cost initially add with the value of financial asset, but subsequently automatically adjust with the fair value of financial asset. Don't worry. And if the transaction cost related to amortized cost method, transaction cost amortized cost method, that is the book value method. It's automatically amortized over the method, over the period. Initially add means capitalize, and subsequently amortize. That's a quick way. Okay. So at first day, financial asset measured at fair value. Number one, adjust with the transaction cost, whatever the criteria is. Subsequently, the financial asset measurement, subsequent measurement. If it's related to fair value through P&L, you know very well, at reporting date, that should be at fair value. Any gain or loss recognized to the profit and loss account. If financial asset through OCI, that should be at fair value at reporting date. Any gain or loss recognized in OCI. If it's amortized cost method, it's a book value method. Book value method means if you purchase any bonds, for example, so irrespectively, whatever the value of the bonds in the market, you have to report at amortized book value method. Moreover, for your revision, for your preparation, the simplified way to proceed more that you have to split the financial asset in 4 components. If the financial asset about investment in equity instrument, if the financial asset about investment in debt instrument, if the financial asset about in accounting for debtors, and if it's about the derivatives. If derivatives not for hedging, only one accounting of the derivative, that is fair value P&L. Debtor accounting is book value accounting. Equity instrument accounting, only fair value accounting. P&L, OCI. You have to decide at initial. Debt instrument, fair value, P&L, OCI, or amortized cost method. Actually, there are 3 possible methods: fair value P&L, fair value OCI, amortized cost method. Only the debt instrument is exist where all the possibilities. Otherwise, equity instrument, fair value P&L, fair value OCI. Debtors, book value method. Derivatives, if it's not for hedging, only fair value through P&L. Now, one by one. In case investment and equity instrument, add initial designation, add initial recognition, we have to designate the equity instrument fair value through P&L generally when it is for held for trading, means short-term capital gain. But add initial recognition if we consider as fair value through OCI, that means that is not for short-term trading. So we can put as fair value through OCI, but it's irrevocable choice. Irrevocable means subsequently it's not reclassified to fair value through P&L. We can say that if our business model, what I use the term business model, BM, business model for short-term capital gain, that's fair value through P&L. Otherwise, fair value through OCI. But do remember that whenever you are sitting in the examination and all, one thing you must have to bear in your mind: accounting for equity instrument at initial recognition, either P&L, fair value P&L, or fair value OCI. It's not about any rule of thumb. It's the wish of the management, either to decide fair value P&L, fair value OCI, irrespectively short-term trading, long-term trading. But generically, it happens with this. Okay, if it's fair value through P&L, so initially you have to record at fair value, and any transaction cost charged to P&L. Subsequently, fair value adjustment to the profit and loss account. Same fair value through OCI, initial recognize fair value, transaction cost initially capitalized, subsequently revalued, and any gain or loss should be OCI. This statement is very much important. Don't forget, any gain or loss not to reclassify to the profit and loss account. For example, fair value through OCI, you have hold the investment for 2 years, and for 2 years the financial statement having the gain, unrealized gain, that's to the other reserves through OCI. Subsequently, when this asset become de-recognized, any previous unrealized gain not to reclassify to P&L, not to reclassify to P&L, but directly to retain earning, equity to equity. That is a key point you have to consider. That is the key point. Candidate, this is a very important revision. This is the very important revision that you have to consider for this point. Okay. Now, the very important thing, investment in debt instrument. First of all, very important thing, you have to develop your mind in a broader spectrum. That's investment in debts. I strongly suggest you have to think like this. You have to think like this. For example, you are a bank and you have investment portfolio. Investment portfolio. For example, you have provided the loan to the public, loan receivable, and loan to the public with different terms, having different portfolios. You have provided the lease receivable, having a broader portfolio. You are a bank. You have other investments, investment in bonds, multiple bonds, short term, long term, multiple bonds. Now, my first thing is that if you provide to the public the loan receivable, or you provide the cars to the public, lease receivable, what is the business model? What is the business model? Business model means what is your investment plan? Sir, simple. For example, loan receivable, we have provided the loan to the public for 5 years. To the 5 years from now. So what is our business model? Year 1, year 2, year 3, year 4, and year 5. The shit Hello. Hello. Okay, I'm back now. Alhamdulillah, I'm back now. Yes, are you getting my voice? Okay, apologies for this inconvenience. Okay, one moment. Okay, class, once again, let's move on. Let's move on. Okay, what I was saying that I was saying that whenever you work out with the investment in debts, you have to consider the important point is that your mindset like this, you are a bank. You are a bank, and you have different portfolios. The portfolio about, for example, loan receivable, for example, lease receivable. If you if you have a portfolio about loan receivable, what is the business model? Think about it. What is the business model? The business model just like this. For example, you provide a loan to me. You are a bank. You provide a loan to me for 5 years. And what you will get return? Interest, the nonsense interest, 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 then redemption. Do you have any concern in the market? Answer me. You will reply, sir, there is no model. This model is no relation related to the market. If you don't have the relation to the market, that means you have to put by book value method. That is amortized cost method. That's important. But on the other hand, you are a bank. You are a bank. and you invest, you have a portfolio of bonds, marketable bonds. Now, there are two possible intentions from your side. Number one, either why you purchase this bond, either held to maturity, number one, or for capital gain. If it's held for maturity, that means business model for capital gain. Sorry, business model for interest only. Interest means interest and redemption only. You don't have any concern related to market. Then you need to work out with amortized cost. But on the other hand, if your intention about the capital gain, so that means something about the fair value. Something about the fair value. So whatever the intention you have, that should be, mark my words, whatever the intention at the making of the transaction, whatever the intention of the directors, that should be reflected on the financial statement. So accounting standard says if the financial asset, if the financial asset is investment in debts, so accounting standard says that amortized cost model, it's applicable if two tests qualify: business model test plus cash flow characteristics test. Business model means you have an intention to get only the interest plus redemption. Cash flow characteristics test means the characteristics of debt instrument, the characteristics of DI, debt instrument. Not our intention only to qualify for amortized cost model. The instrument is also having the only written capability about the interest and redemption, no other than that. For example, if you invest in CD, convertible debts, it's not meeting the cash flow characteristics test. If it's not meeting the cash flow characteristics test, then convertible debts by default at fair value, by default. So it's important to meet the business model test as well as cash flow characteristics test. As well as cash flow characteristics test. That's important. Another one, other than convertible debts, leave it convertible debts, but at designation, both possibility exists: fair value and OCI. If you invest in marketable bonds with the intention for the short-term gain, clearly declared short-term gain, you don't have any intention to get the interest and redemptions. In the meanwhile, get the interest no matter it is, otherwise you don't have any intention. So you will work out accordingly. You will work out with the fair value through P&L. But on the other hand, this is also important, fair value through OCI. If invest in debt instrument, and you have an intention to hold for long-term maturity, but But you says that management says that if something happens unusual, then we can sell also. Then we will qualify for fair value through OCI. Okay, move on. That is the debt instrument. Amortized cost, fair value OCI, P&L. Important, you have to mention business model test, cash flow characteristics test. That is contractual term. Cash flow characteristics test means the test of debt instrument. Business model test means intention test. Cash flow characteristics test means the test of debt instrument. That means the instrument only have the characteristics of the cash flows. That is solely the principal interest and the premium as well. Means the instrument don't have any chances to get the market exposure. For example, the convertible investment in convertible debts. So convertible debts includes interest, principal, as well as the exposure of market conversion. That's why convertible debts not meeting the contractual terms means cash flow characteristics. I hope that it's clear now. Candidates, can you please reply me about the clarity of my voice? Okay, thank you very much. Okay, move on. Yes, we have to move on. IFRS 9. Yes, it's important about the IFRS 9. The IFRS 9360. IFRS 9360. Right now, we are reviewing the basic concept. Okay, here the details mentioned, fair value OCI, fair value P&L, all these matters. Okay, read this question. Read this question. Come on, quickly read this question. And reply me. What should we adopt? Yes, come on, come on. Paloma. Yes, come on, come on. Yes, the question is about that. Paloma purchased new financial asset 31st December X3. Asset is bond. That's marketable. It will mature 3 years. Paloma buy debt instrument with an intention to of holding them to maturity. Although has no occasion sold them investment if cash flow deteriorate beyond the acceptable level. So the bond pays market rate of interest. Finance director unsure whether the financial statement measured at amortized cost. Advise finance director how to measure the bond. Yes. Candidates, do remember the very important point. What I said to you, you are a bank and you have a portfolio of bonds, number of bonds. And you have multiple portfolios, no? Multiple portfolios. We are talking about number one portfolio. This portfolio, one of the portfolio. Do remember that if we designate something related to some part of portfolio, we have to focus the decision on the basis of substantial basis. Here, the question mentioned that some of the investments sold on occasion sold some investment. this sum investment not reflecting the complete part of the portfolio. Although it's mentioned that at some moment we will sell the investment, but the director says that some of the investment will sold. So this sum of the investment, it's not reflecting the complete portfolio. So that means this statement is that not affecting that we are declaring as a fair value through OCI. Rather than we have to measure at the amortized cost method. That's an important point. Do remember, it's about the substantial materiality. That is important. Yes, I said to you that if the company has intention to sell the portfolio, but if it's mentioned that majority of the portfolio will sell in future for some occasion, then we will declare that fair value through OCI. That's a key point. Okay, move on. That is okay. How to measure that? It's very simple measurement. I'm not discussing right now the basic maths of the amortization model. Amortized cost model, you know very well that the balance, then interest income by effective interest rate minus interest received coupon rate multiplied by par value is equal to balance end. This is what the basic maths you have been doing since FR. We are not here to wasting of the time to making this boxes. Yes, initially amortized cost method, transaction cost should be added. Fair value through P&L, you know very well. Furthermore, the fair value through OCI, I must say you have to revise from your regular course. Don't ignore it. I know that it's not till now examined, but you have to. That's very much important, especially fair value through OCI. That instrument. Okay, move on. This is one side of the picture. That is financial asset. Another side of the picture, that is about the financial liability. Listen carefully. A quick review of financial liability. Don't mix the financial asset with financial liability. Listen, class. Listen here. One part of the balance sheet, that investment here, financial asset. Investment in shares. Investment in debts. Both are financial assets. But if we are issuer, two different things. Financial liability, equity instrument. So now we are discussing financial liability. Financial liability. Can you please reply me about the clarity of my voice? Can you please reply me about the clarity of my voice? Now, hello? Can you please reply me about the clarity of my voice? Okay, that's good. That's good. Okay, come on. Come on. That is the time for the financial liability. Accounting standard says, number one, you have to develop your mindset. which liability we will known as financial liability? Which liability we will known as financial liability? Number one, contractual obligation to pay cash. Contractual obligation to pay cash. For example, loan payable. For example, issuance of bonds. These are the examples. Loan payable, issuance of bonds. These are the examples. For example, derivatives, unfavorable condition. Derivative and unfavorable conditions. Derivatives, unfavorable conditions. Okay, so the point is that these are the basic examples of the financial liability. Creditors, derivatives, very basic examples. But initial recognition, how to recognize initially? How to recognize initially? Financial liability will initially recognize when become the part of the contract, when become the party. Number one. What is the accounting? Majority case, financial liability will be recognized at fair value through, sorry, at amortized cost method. But here, in a very rare cases, at fair value through P&L, like derivatives, like some accounting mismatch. We will discuss later with the hedging. Accounting mismatch. Accounting mismatch. Number one, basic amortized cost method. If amortized cost method, transaction cost adjusts with financial liability subsequently charged to the P&L. But if fair value through P&L, transaction cost immediately charged to the P&L. Subsequent measure, financial liability, amortized cost method, fair value through P&L. Amortized cost method means book value method. P&L means revalue over the period. It's very simple. Okay. What are the equity instruments? Once again, issuance side. What are the equity instruments? Equity instrument means, listen carefully. Listen carefully. It's now we are entering with the very critical part of IFRS 9. If we issue equity, so whoever the holder of this equity, whoever the holder of this equity, holder has a right of residual interest. Residual interest of this entire business. Residual means remaining, whatever the remaining part belongs to this equity holder. But if you issue the debt, So the holder at that place don't have the right of residual interest. That is a very critical aspect we need to cover. Debt holder don't have the residual right. Debt holder having the right for the interest and redemption only. But the equity holder has a right of the remaining residual interest, either residual higher or lower. It's a risk. So that's why the definition of equity instrument. Equity instrument contracts that evidence residual interest in the entity after deducting all liability. But sometimes, we issue instrument is hybrid instrument, convertible debts, compound financial instrument. And at that point, since FR, you are studying that the compound instrument, whenever you issue, you have to split the liability and equity component. Liability means whatever the present value in the form of cash commitment, that's interest, principal, premium. And the value of convertible debt that you issued is a gross amount minus the liability component remaining the equity component. And subsequently, liability will be made amortized and the equity component adds the original value. That's all. That's all. This is what the basics I've reviewed with you. But now, and you have to attempt for this convertible debts SBR specimen 2. Now, come on, candidates. Yes, come on. Call everyone. If anyone wants to review the derivatives, that is what the very critical aspect for you people. Candidates, do remember one thing. I always told you, I always discuss with my students that whenever there are some complexities with the topic, number one, you have to understand the thing in the 2 steps. The first step is about the understanding of the issue. What is an issue? Then number 2, at that particular issue, what should be the reporting structure? What accounting standard says about the reporting? But first thing is that try to understand the topic derivatives. Try to understand the topic derivatives. So number 1, what is the meaning of derivatives? Number 1, I am not discussing about the reporting of the derivatives. I am discussing about the term derivatives. Derivatives. Listen carefully. First January 2020. For example, you are an airline company. You are an airline company. Whatever the airline, for example, Emirates or ABC airline, whatever. Sorry. Your financial year, your financial year first January 20, 31st December 20. You are an airline company. Airline. At 1st October 2020, your management have some concern. The management has some concern that For example, by the next 6 months, means October 20 till March 21, the price of fuel, oil prices will increase. The oil prices will increase. And you have a concern point. So somebody says that if oil prices will increase in the future, what to do now? So for example, you have purchased a forward contract, a forward contract with the bank, forward contract with the bank. And what you committed with the bank that now the prices is, for example, $10. Now bank offer you a forward rate of 31st March 21. That is $11. And bank says to you that at 31st March 21, if this price 11 exceeds or it decrease, increase or decrease, you will be able to commit with this $11. There will be no change. So that means if we commit the contract with the banks, of the forward contract with the banks, if the price increases, for example 12, 13, 14, we will in a position of the advantage. But if price decreases, our position will be lost. Furthermore, this statement is very much important. Now I'm saying that at 31st March 2021, there are two possibilities with this contract. Two possibility means there are two possibilities with this contract. Either I will buy the oil with bank, means I will execute the transaction. I will actually buy the execute means I will actually buy the oil from the bank, or I can settle in cash. I can settle in cash. Settle in cash means I will not buy the oil with the bank. If the price, for example, from 11 to 12.5, I will just net settle and get 2.5 from the bank. These two of these two are different things. If we are going to purchase the oil, that is called executory contract. And if we are moving towards the settlement in cash, that is non-executory contract. Non-executory contract. Okay. Both possibilities exist, either executory or non-executory. Number one, our standing, listen carefully, don't confuse. Our standing at now means 30, sorry, are standing at 1st October 2020. and we have made this transaction. And do remember in SBR exam, the issue is not, we will not handle the case at 31st March 2021. Instead, the case is that if we entered with the transaction and we are now become at year end, our position is this. At the year end, we have noticed that some months ago, the company has made a transaction that's called forward contract. And this forward contract has characteristics. Its initial value is zero. The contract initial value is zero, means when made the transaction with the bank have paid nothing. Number one. Number two, the contract value will move as the time goes on. Means after 1st October, the things move on. Means actual oil price move. The contract value will also move. And last, the contract has the characteristics of the cash settlement. Yes, cash settlement means we will not execute. We will not execute. We can settle with the cash only. What will happen at the end of the day? Leave this point right now. Accounting standard says that if these characteristics exist with any contract, number one, that will settle in future. Initial value nil or very little. Very little we will discuss with the option contracts. And its value change in response to change in specified underlyings. If these three characteristics exist, that's contract called derivatives. And the very important thing, the derivative contracts are non-executory contract. Non-executory contract means the company don't want, although the contract has the characteristics to execute, but the company has no intention to actual buy the oil, rather than just settle with the cash. So called the betting, the gambling, in Urdu, the satta. So it's all about the gambling. So called speculation purpose. If we enter the derivative only for speculation, that's only one accounting, that's called fair value through profit and loss account. Ignore hedge accounting. We will discuss hedge accounting later after 11 p.m. Now listen, read this example. Read this example. Chocolate manufacturer worried that piece of cocoa might increase with the adverse effect its cost of production and operating profit. Company could manage this risk by entering the forward contract to fix now the price future goods of the cocoa. By fixing the price now of for purchase, for future purchase, the risk of the adverse movement in the market of the price cocoa is removed. What I say, the contract is not for the purpose of actual buy the inventory. That is cocoa. But settle the forward contract with the net settlement in cash. Class, either concentrate here. Whenever, listen carefully, whenever a company enter into a derivative contract means having the three characteristics: initial value 0 or nil, will settle in future, having the cash characteristics, and value will be changed over the period. Listen carefully. These are very important statements. At the end of the contract has two characteristics: either settle in cash or execute. We are standing at year end. Sir, if a company enters into a derivatives, we are at year end, and the contract has both characteristics, cash or characteristics or execute. So we will declare only the derivative if we will settle in cash. Sir, how we will evaluate the situation at year end that after the year end it will settle in cash? This is a very critical question. If we are standing at the year end, but the contract has the characteristics that actual buy the oil or net in cash, because if it's net on cash, that's derivative. If it's not about the cash, it's execution, that's not derivative. So how to evaluate us? Accounting standard says, listen carefully. Accounting standard says you have to evaluate the situation with these terms. Number one, the derivative contract permits to settle net what the entity has the practice, means past practice, of similar contracts, practice of taking delivery of the item. Are they readily convertible into cash, the contracts? And the case will definitely mentioning some clue that if the contract has the characteristics of cash and execution both, but the company having some past practice, and based on that past practice, you have to consider this point. Now, one more important thing, now we will discuss exam question one. Listen, I will take your question, don't worry. Hold it, I will take the questions. Derivative. For example, I say that I purchase a derivative of investment in shares, or I will purchase a derivative of oil. So listen carefully. I have purchased the derivative of financial asset because investment in shares is financial asset. And here the oil, it's not under the scope of financial asset. It's not under the scope of financial asset. So I have purchased the derivative of non-financial asset. So do remember that whenever we purchase derivatives, either for financial item or non-financial item, derivatives accounting under the scope of IFRS 9. For example, I say that you purchase the bonds, you purchase the shares. What is the accounting standard? You say that, sir, IFRS 9, financial asset. But I say that if you purchase the inventory, what you will say that? Is that IFRS 9? No, it's IS 2. But if I say to you, you purchase the derivatives of investment in shares, that's IFRS 9. And if even you purchase the derivative of oil, derivative of investment property, it's still investment property. It's not, it's not IFRS 9, but derivative of investment property. Stocks is not IFRS 9, but derivative of stocks, IFRS 9. That's why these terms mentioned here. I have mentioned here more discussion about derivatives for non-financial item. Never confuse. Non-financial items are asset and liabilities which is outside the scope of IFRS 9. However, derivatives contract of non-financial item under the scope of IFRS 9. Contract to buy, sell non-financial items such as inventory, property, plant, equipment is only a derivative if it can be settled in cash and the contract was not entered for the purpose of receipt or delivery. Means not for the purpose of execution. Non-executory. That's important. That's important. IFRS 9 says that buy or sell non-financial item considered to be settled in cash when contract permits. Means contract has the characteristics of settle in cash. Net settle means cash. Entity has the past practice. And readily convertible into cash. That is the point. That is the key point you have to consider. If I say that an exam question, come on with the exam question. I must say that first you have to read this question. Yes, SML, a tool manufacturer. It's ICWE question. Read it. The Pakistani people, Indian people, and even Bangladeshi know very well what is the meaning of satta. And the, in English term, that's called gambling or the speculation. Okay, read this. Question number 2. SML, a tool manufacturer, entered into contract to buy 50 tons of 12 months time, according with expected use requirement. Contract to buy 50 tons of steel, 12 months time. The contract permits SML to take physical delivery of steel or pay or receive net settlement in cash based on changes in the marketplace of steel. Is the contract account for derivative? What you will say? The contract meets the definition of derivative. That is, there is no initial investment and to be settled in future. Number one, this is derivative. There are two things. Number one, the contract is derivative, yes. But should we report as a derivative? However, because derivative about non-financial item. This is the non-financial item. Yes. Steel purchasing. Steel is a non-financial item. Because derivative about non-financial asset classification as a derivative depend on whether contract enter into order benefit for the short-term price fluctuation by selling it. If SML intends to take delivery of the steel and use it part of purchase production, then the contract is not the derivative. I hope that you people now got an idea how to write the thing. Yes, it's a judgmental matter. We are not here to clarify the things. That's what actually happened, even in the exam. Class, come on. Specimen 2, September 18, Gustoso. This is the question. You people already have. Read this question 1. Yes, I know that it's a question number 2, ethics. Why don't we, we should start the point of the ethics as well, because it's about the SBR 360. We will discuss the knowledge of the standard with other part as well. Yes, please read it carefully. Read it. Faisal, leave it 360. Ignore, please. Concentrate on the question. Okay, class. Quickly. Discuss the ethical and accounting implications. We will discuss the accounting implications right now, ethicals later on, of the above situation from the perspective of the accountant. Professional marks award for the 2. Gustoso, a public limited company, produces a range of luxury Italian food products sold to restaurant, shops, and supermarket. It prepares a financial statement according to IFRS. Director of Gustoso receive cash bonus each year if reported profit from the period exceed predetermined target. Oh, the salary based on profit targets. Gustoso has performed excess of the targets in year end 31st December except. Forecast X8 and however pessimistic due to economic uncertainty and stagnant nationwide wage growth. Okay, so there is a clear indication that the target has already met for X7, and due to some personal reasons, they may, director may manipulate the figures. That's uh, reflecting to exaggerate the next year profits. Okay, a new accountant recently started work as Gustoso. She noticed that provision balance at 31st December X7 significant higher in the prior year. She made inquiries of the director, who explained that increase was due to substantial change in the food safety and hygiene laws, which become effective during exit. As a result, Gustoso must retrain a large proportion of the workforce. Must retrain. Retraining has yet to occur, so provision has been recognized for estimated 2 million. Finance director then told to accountant that such inquiries were a waste of time and would not be looked at favorable when deciding on her future pay rise and bonus. So this one is ethical issues. But before ethical issue, first of all, can you please reply me based on the yesterday's lecture? Can it be possible to allow according to IS 37? Can we make the provision for this retraining? Hello. Can we make the provision? No, we cannot make the provision. So how can we uh, reply with the paper? Do remember that when you are working with the ethics part of the question, examiner categorically mentioned that accounting and ethical implications. So first make a heading accounting and do, and you have to reply the accounting issues. Number one, provision, accounting implications. Number one, provision. Number two, wheat contract. Then in the last paragraph, ethics, make a heading of ethics and then put it accordingly. Your views. Okay. Number two, the another one that's very important. Gustoso purchase a significant quantity of wheat for use its bread and pasta product. The These are high value products which Gustoso records significant profit margins. Nonetheless, the price of wheat is volatile. And so on 1st November X7, Gustoso entered into a contract with a supplier to purchase 500,000 bushels of wheat in X8, $5 a bushel. Contract can be settled in cash. So this is clear that contract has a characteristics of the derivative. But should we report as a derivative or not? That's important. Gustoso entered into similar contract in the past. Similar contract in past. And do remember, this is about the wheat contract. And wheat is not the financial asset. And we have entered with the derivative contract of the wheat, having the characteristics of the cash and the taken delivery as well. By 31st December X7, price of wheat had fallen. Oh. Finance director recorded a derivative liability of 0.5. Statement of financial position and loss of 0.5. This is a derivative contract. Number one derivative, yes. Number two, if it's a derivative, should we report as derivative? This is the question mark. Although it's a characteristics of the execution as well. So what we will say that this is a contract of derivative about non-financial item, but we cannot report as a derivative. It's an executory contract. Wheat prices may rise again before June. Accounted unsure. Current accounting treatment is correct and feels uncomfortable. Finance director again. Class, one important thing. Normally, you people have a confusion. I have a question with you. A simple question. It's not about a derivative. A simple question with you. 1st November 2019, 2020. I have made a I made sorry, have contact to you and made a commitment with you. Not the commitment, made a contract with you. I said to you that I will purchase your inventory after year end. I will purchase this machine, asset, whatever, after the year end. So should we report something here? Can we report at something here 1st November 2020? If somebody commits that I will purchase something from you in future, can we report something? No way. It's no way. It's no way to report anything. Until unless it's a derivative and it will be settled in cash. So if the wheat contract is a derivative and having the characteristics of set delivery, having the characteristics of the delivery, and our past experience says that we will pick the contract, we will purchase the wheat. So we will not report as a derivative. On the other hand, it's an executory contract. If it's executory contract, Right now, we cannot report anything. Right now, we cannot report anything. That's the important thing. Candidates, you people can read it accordingly. Very simple. Number one, provision, same case. The knowledge, the case. Then derivatives, again the knowledge and the case. I'm not discussing right now about the ethics. I will discuss the ethics matter by tomorrow. A comprehensive lecture about the ethics. Candidate, is that clear? I hope that based on my lecture, you got some confidence about how to handle the derivatives matter. But after the derivatives, some more things are still waiting. Some more things are still waiting. And very important things about the details related to the financial instrument definition. Okay, candidates, take a 10 minutes break. Come back by 10 minutes because the things are very critical. For next 1.5 hours, I will extend the session by 15 minutes more today. So these are very important. So take a 10 minutes break. And if you have any question, do ask me. Thank you very much. Break start now. Amen. I've already shared um, the handouts to you people. Um, you can coordinate us through the WhatsApp group. I'm sharing the another link of the WhatsApp group. You will get the WhatsApp group accordingly. Thank you very much. Okay, come on. Class, are you hearing me? Can you please reply me about the clarity of my voice? Hello? Okay. Now next thing is to work out some more details. Some more details. Candidates, the very important thing is that whenever you make a review about the financial instrument, I strongly say that yes, I must say that you have to make a quick review about the complete definition. You have to work out with a complete definition as well. So you people have already the handout of this. Can you please read the definition once? Can you please read the definition once? I'm giving you 1 minute only. Please read the definition once. Okay. Number one, cash is a financial asset. Equity instrument of the another entity is a financial asset. Contractual right to receive the contractual right to receive cash, financial asset. Contractual right to receive or exchange another financial instrument that are potentially favorable. Actually, these are derivatives. These are derivatives. In case you are the holder of the derivative, for example, holder of forward, holder of futures, holder of option, and holder of option with a favorable condition. Holder of option under favorable condition. That's important. Okay. Leave it 5 or 6 points. Financial liability. What are the financial liability? Financial liability that is the contractual obligation to deliver cash or another financial asset. And to contractual obligation of the financial instrument with another entity that is potential unfavorable. For example, for you are a holder of forward contract and situation is losing. You are holder of future contract, situation is losing. And do remember, in case of option, it's not possible to losing the situation by the holder. I must say that writer of option, writer of option. Now the candidates, a very much important definition, very critical. This is very critical point that we are going to discuss here. Listen carefully. We are here to discuss about the definition about financial asset, the definition about financial liability, and definition about equity instrument. Definition about equity instrument. Listen carefully. This is a very critical point. For example, we are making balance sheet and we are reporting debts or equity instrument. Debts means the company issue the debts or the company collect the cash and declare the debts. That means contractual obligation to pay cash. Contractual obligation to pay cash. Equity instrument means holder of equity instrument having residual interest, RI residual interest. But sometimes the case is very complex to distinguish between either its debts or either its equity instrument. The special case the special case about share to be issued. The special case about share to be issued. Special case about share to be issued. That means we haven't issued any shares, but we have made some commitment to issue in future. Some commitment to issue shares in future. Let's take an example. For example, you're standing at 1st November. The company has made a transaction at 1st November 2020. The company has made a transaction at 1st November 2020. What the transaction has made by the company? The company has made the transaction that, listen, the company has made a transaction that at 1st November 20, a machine the company has purchased worth $100,000 and commitment to pay by shares, by equity shares. By equity shares. When at 1st Feb 21. First Feb 21. And the company committed that to the holder, we will provide you 10,000 shares. We will provide you 10,000 shares. It's committed. 10,000 shares. 1st November 2020, it's committed that we have purchased $100,000 machine, and we have committed with the supplier that we will provide you 10,000 shares. Market value of share now is $10. Now means 1st November. If price increase or price decrease, the whole risk belongs to holder of this contract. Accounting standard says that at 1st November 20, you purchase the machine. And if you committed to issue shares that is fixed in number, so you must have to credit equity. You must have to credit equity. Sir, why it's equity? Sir, it's why equity? Because the holder bear the risk. If share price increase or share price decrease, 10,000 share will receive by the vendor. We as a company, this to be issued transaction declared as equity instrument. Declared as equity instrument. Leave it about we will work out for the premium or discount. Yes, we will work out according to the premium or discount, whatever. We will record with this. But equity, we will discuss with the equity. My another example, candidates, if a company, second example, purchase a machine, the value 100,000, and today is 1st November 20, and committed to the supplier about 1st Feb 21. 1st Feb 21. That market value of share right now $10. And the company commit that whatever the price here, based on this price, we will provide the shares. If price increases, then the number of shares decrease. If price decreases, number of shares increase. Which means that the ultimate holder of the contract will receive the same amount. Same amount means number of shares will fluctuate. He or she will not in a position to take any risk. If the value of shares decreases, value of price decreases, the number of shares will increase. So in this case, number of shares is variable. And accounting standard says at that point of time, you have to report machine debit, although committed to provide own shares, but credit is liability. But the credit is liability. because here the holder is not taking the risk. That is the point. That is the complex issue. The first case is called fixed for fixed. The second point it says fixed for variable. Fixed for variable. If something about variable, and do remember that this is not the derivative contracts I'm discussing. This is what share to be issued means actually issued. Actually issued. Moreover, statement, listen this statement carefully. In some part of the world, it's illegal, but where it's allowed. If some derivatives about own equity instrument, if some derivatives about own equity instrument, if some derivatives about own equity instrument, the rule is same as other derivative. Do remember the important point. In derivatives, always number of instruments always fixed. What does that mean? For example, I say that derivative for shares. So you must reply that, sir, how much shares? How much shares you have taken the derivative? Okay, derivative for oil. Sir, how much derivative for oil? How much numbers? At any particular time, the derivative instruments always fixed. Instrument always fixed. But cash settlement in future is always variable. Cash settlement in future always variable. Cash settlement in future always variable. For example, if we stand at year end and we have came to know that the company 1 month ago contracted with some derivatives of any contract. So numbers always fixed. But in future, the settlement in cash always variable. Nobody knows what will actually happen. So if there are any kind of derivatives, including own equity instrument, for example, you are Unilever's. For example, you are Unilever's and you have purchased your own company's derivatives. You are Toyota and you have purchased own shares future contracts. So the rule is same as discussed above. Rule is same as discussed above. That's a key point. Now, candidates, it's a time for the questions. But I must say that I strongly suggest you have to read the page number 16. Please read page number 16 very carefully. This is a very technical part of the syllabus and you people normally facing a lot of issues. Page number 16 and page number 17. Please read page number 16 and 17. I'm giving you 2 minutes. Page number 16, page number 17. Once you're done, please reply me. Once you're done, please reply me. I hope you people are getting confidence with this IFRS 9 context. Okay, move on with the questions. We don't have very much time. Number one, you will get more clarification with these cases. Come on. Case one. Coaster wishes to purchase a new ride for its Animation Galaxy theme park, but requires extra funding. So they have issued the preference shares. So they have issued the preference shares. Okay. Discuss whether these financial instrument classified as financial liability or equity instrument. Okay, case one. 1 million preference shares, $3 each. No dividends are payable. Okay, they issued the preference shares, they have collected the money. Coaster will redeem the preference shares in 3 years' time by issuing ordinary shares worth 3 million. These are further complex cases. Exact number of ordinary shares issuable based on the fair value 30th September X6. Means you have issued the preference shares and these will be converted into number of shares. The worth is given 3 million, but the number of shares will be based on 30th September. What you will say that? What you will say that? No. Candidates, this is the wrong answer if you say that preference shares means loan. You are wrong. It means you haven't studied the SBR. You haven't studied proper IFRS 9. This is not simple preference shares. You have attached the issuing of number of ordinary share as well. Means you have issued the preference shares and you have told to the holder that we will not provide the dividend, but redeem the preference shares, convert into the number of equity shares. And the number of equity shares, how much number of shares, it will depend in the future. So because of that, these preference shares convertible into ordinary shares, but the convertible conversion number of shares is not fixed. That is why it's financial liability. If convertible shares, equity shares is fixed, if in that case, then we declared as a equity. I-32 states financial liability. You will write in this manner: knowledge, any contract that may be settled entity on equity instrument and non-derivative, it's obliged to deliver variable number of equity instrument. Therefore, a contract requires entity to deliver as many of equity instrument equal to certain number of traded asset debt. Coaster redeemed the first set of preference shares, issuing ordinary shares equal to value of 3 million. So this 3 million preference share classified as liability. Initial measurement at fair value, that is present value future cash flow, and subsequently amortized cost. Yes, fixed for fixed or variable test. Now read this. Case 3. Case 3, please. Case 3. 2 million preference shares, 2.8. No dividend payable. Preference shares will be redeemed 2 years time by issuing 3 million ordinary shares. Fixed number of shares. So that should be classified as equity in the statement of financial position. If you issue the equity, initial value 5.6 and equity issued, it remains same. I hope that the things are clear very much. Normally, you people are not working very much for the IFRS 9. I know very well how you handle IFRS 9. Huh? I'm not talking about this. Okay, SBR 360 means knowledge, means ethics. Number 3, performance measurement. I told you. Yes, I told you earlier. And there is also a current development related to this equity and liability. That is discussion draft. I will deliver a video for this. My I will share you a video. You just pick the things for the current development from there. Read it once. It's very simple. Significance of debt and equity in the financial statement. What we will say, debt and equity is very important, since the classification of instrument, either debt equity, can significant impact on the entity's report, earnings and gearing ratio. Gearing ratio, return on capital employed, all of these, and effect on the debt covenant. For example, if some transaction you have made, that should be liability, but you are uh, reporting as an equity, so that means gearing wrong. Your debt covenant conditions also wrong. Companies may wish to classify financial instrument equity in order to give favor impression of the gearing, but this may turn negative effect on the perception of existing shareholder if it's seen diluting equity shares. Distinction is also relevant. Business combination. Yes, this is important. This is another important point. Yes, listen here. For example, listen. You are parent and you purchase subsidy 80%. You have purchased subsidy 80%, and you are subsidy equity shares A class, B class. A class 80%, this is 20%. And purchased, parent purchased this 80%. So that's why you are consolidation. Okay. So you are consolidation. Huh? What you are consolidating? You are consolidating NCI. This class B shares as NCI. But if you deeply involved with accounting standard, what happened actually? For example, this is the case. Actually, subsidy wrongly declared this NCI, this 20% in equity. It should be non-current liability. Then what you will say? If subsidy individual books, it should be non-current liability. So in consolidation, it should not be NCI. If subsidy non-current liability, that should be as a non-current liability. Yes or no? So even the consolidation hit it. Getting the point? This is also the matter. Examiner one time examined this point at P2. Candidates, you can attempt these questions accordingly. I don't have enough time. This is the questions and with the solution. You can easily pick the things, work out accordingly. These are very clarified. This is actually the gift for you. All the cases here, own equity instrument, derivatives. This is actually a gift. You must have to provide a pray to me. Pray, don't praise, but pray. You can work accordingly for each case. Now, the next point. Mubashir, you have to view the video one more time. You will get this point about the consolidation aspect with the example, please. Or if people have any confusion about the consolidation aspect, that's if subsidy, one more time, subsidy, if subsidy equity, some part of the equity wrongly declared as equity, and that should be liability. So it means your consolidation will also be wrong. You are putting that as a parent, you are putting that equity as NCI, but that should not be NCI. Instead of that should be liability. That is what I'm saying. Okay, move on, candidates. Another part, that is de-recognition. Another part, that is de-recognition, candidates. De-recognition. What is the point about the de-recognition? What is the part of the de-recognition? What is the meaning of the de-recognition? De-recognition means at what point you will allow the financial asset to be de-recognized. I am asking one question with you, a simple question with you. For example, you have a financial asset, investment in shares. That carrying amount is equal to fair value 100,000. Let's suppose. Okay. Let's say I say that you have sold this financial asset. You have sold that financial asset. You have sold it. But same time, a repurchase agreement. at fixed price. For example, you require some amount of money. So you have sold this $100,000 shares to the bank and have made agreement at same time that we will buy back with you 103,000 after 15 days or after 10 days, after 1 month. So can we say that it's a sale? Can we say that it's a sale? Yes or no? Please reply me. You will say that, sir, you have transfer the financial asset. You have transferred the financial asset, but this transfer not qualify for derecognition. Not qualify for derecognition. Because risks are and are risk and reward, not transfer. Because risk and reward, not transfer. Because risk and reward, not transfer. So that is the key point about this topic. That is the key point about this topic. IFRS 9 says that criteria for derecognition. Number one, either contractual right to the cash flow of the financial asset expire. For example, expire account receivable is the financial asset. Yes, you have received. So that means derecognize the contractual right to receive expire. You are option holder. You have paid the premium. You have reported as a financial asset. Contractual right to receive cash in case of favorable condition. The time expire. The condition become unfavorable. So that means financial asset right expire. So you can derecognize a financial asset, number one or number two. Number two is what? Entity transfer the financial asset. If not expire the contractual right to receive cash. Okay. Second thing, transfer the financial asset and transfer qualify for derecognition. One more example. One more example with you. For example, you have a financial asset. For example, investment in bonds, marketable bonds. You have sold that bond in same time by the call option. Call option means right to buy at exercise price. Exercise price means fixed price. Fixed. It's fixed. The price is fixed. But you are a you have sold it, number one. Sold means transfer. Plus, is it qualify for derecognition? Is it qualify for derecognition? So you say that we have a right to buy. If favorable, we will buy back. Not favorable, what? Not to buy back. So what to do at the year end? Either we will consider as favorable, unfavorable. You will evaluate the situation. That is this favorable or not? If it's favorable, favorable means in the money. In the money means it's having some value for you. then you will say that, okay, it's transfer. And if I'm going to buy back it, so that means it's not for de-recognize. If it's not favorable, option not favorable, that means transfer, and transfer qualify for de-recognition. Yes, we are considering the substance. We are not considering, very good point. We are considering substance. We are not considering the perceptions. We are not considering the perceptions. So you please work out with these examples, and examiner has examined in September 18. And do you know that the word simulate, what does that mean? Candidates, do you know that? What is the prime rule to qualify your exam, to qualify any project? That is honesty. Honesty means hard working, no shortcuts. How how you evaluate that you are in the right track for the hard working? It's a simple criteria to assess that you are in the way for the hard working or not. Being as a Muslim, pray in pray two rakat salah in front of Allah, in front of God, or whatever the religion you have. You just stand in front of your God, Allah, and just give 30 seconds, a talk with the 30 seconds with Allah, and ask yourself that am I right track for the hard work? And if your eyes blinks with some witness, then you people are in the right way. The prime thing is the hard working. And for hard working, the important thing is that evaluate your situation. Simulate. Simulate means you have to perform the question by yourself without any fear that if I attempt that, that will be wrong. Do it now if it's become wrong. Why you are waiting for the examination hall? Simulate the thing and realize your situation where you are stand. And do remember the most important point. The growth in the life always in this manner, not in this manner. Because this is not life, this is death. If the line is straight, that's that. This is life. This is the quote by the Ratan Tata, the business tycoon, the pioneer of the Tata Group, India. So you move in this manner, yes, you will grow. Then sometimes you lost the situation. Then move on. Then move on. The important thing is that you will grow. Simulate. If something saying that simulate, that's do simulate. You people are asking that do you have the 100% course notes? What you will do? We are here with the ACCA commitment that to provide the right track. Why you are searching just the notes or like this things? Develop the right path with your own. You will get the destination. The important point is that this is the September 10, 2018 question about the de-recognition. I don't have enough time to discuss this point because I have work out. I've given the question here. This is the marking scheme. This is the marking scheme, and you have to perform simulate. Please simulate before move forward. Simulate first. Simulate first. Then attempt. Then refer the solution. Don't refer the solution before that. Now this next part is about the impairment. In SBR, examiner has examined only one time the impairment. Only one time, March 20 exam. I will discuss the maximum point about the impairment and the heading as much as possible with you people. Okay, candidates, are you getting the point what I'm saying to you? Hello? Will you do the simulation, exam simulation, yes or no? That's the important thing. That's the important thing. Okay. The very important thing about the IFRS 9, that is about the financial asset impairment. Make up your mind. Number one, focus on financial asset and then impairment. I will discuss the only important aspect about the impairment. If something about an impairment related to investment in equity instrument, don't worry, don't worry, because automatically adjust with the fair value. If you have any workout with the investment with respect to derivatives, don't worry, impairment automatically adjusts with fair value adjustment. But the issue is about investment in debts and its amortized cost method. And its amortized cost method. Its amortized cost method. If investment in debts, fair value P&L, don't worry, it's automatically adjust fair value adjustment. But the point is that if it's about investment in debts, amortized cost method, then the issues are critical. Then the issues are critical. For example, you are a bank and you have a portfolio of multiple loan. I'm not talking about individual loan. I'm talking about portfolio of multiple loan. Portfolio 1, portfolio 2, portfolio 3. For example, this one is, I'm taking portfolio number 3. You have reported that financial asset debit, bank credit. And this portfolio about, you have provided a loan to the commercial loan to the industrialist. For example, you have provided the loan to textile industries. Textile industries. Number of textile companies here in this portfolio. A special package for the textile industries. And assume that your country is textile based country. Your economy based on textile. There's a boom. Most of the exports, local markets established. You have a best cotton in your country. No chances of defaults like this. Accounting standard says that. Accounting standard says that. Because the banks provided the loan to the borrowers, the money the bank collected from the public. It's actually the money of the public. So for the impairment loss working, don't wait that something actual happen. You have to report the impairment or the losses on expected basis. Means whenever you have developed the portfolio of the loan, you have to determine, you have to assess Is there any chances of the defaults or no? If there is any chances of the defaults or no? On that basis, IFRS 9 has established an impairment criteria. The previous IS 39 criteria of the financial asset impairment is based on objective evidence. Means you must not uh, make any working of the impairment until unless some objective evidence arises. But IFRS 9 says that no, must have to develop some conscious approach, must have to develop some conscious approach, must have to develop some conscious approach. And this conscious approach called expected credit loss approach. It's a forward looking model. It's not based on objective evidence. It's not only based on, it's expected basis. That's a key point. Accounting standard says that actually, whenever you establish the financial asset, you have to develop an allowance. Allowance. Let's say allowance for credit loss, credit and P&L debit, impairment loss debit. It's same like the account receivable. You normally, based on the aging analysis, the debtors at one side and allowance for doubtful debts another side. Like this. Normally, in the balance sheet, what do you do? Debtors minus allowance, net figure. Both accounting, both ledgers are different. But in the balance sheet, you report with the net amount. Same like this. You have to develop impairment allowance. This is a separate ledgers, financial asset working at amortized cost method. In the balance sheet, that should be netted off. That's the point. But the point is that, very critical point, sir, what should be the value of this impairment? Yes. For this measurement, accounting standard has established to some working. Accounting standard says the number one to develop the credit loss. Credit loss means credit loss means credit loss means listen carefully. Let's suppose 1st January 20, listen carefully. 1st January 2020, you have provided me a loan of 100,000 with the 10% coupon rate. Redemption at same, and that is 3 years. What if I make amortization schedule, AS amortization schedule? Year opening, interest income, interest received, balance. Year one, 100,000, 10%, 10%. That is 10,000, that is 10,000, plus minus is equal to 100,000. Simple. Year two, 100,000, same. This table I have made in a manner that all the things will execute as norm. But accounting standard says if you stand at that point, first of all, consider that Do you know that what is this 100,000? This 100,000, you make entry financial asset debit bank credit with this 100,000. What is this 100,000? Is this the amount you give to me? No. Actually, this is the amount present value of future cash flow. Means you, you will receive 10,000, then 10,000, then 10,000, and then 100K. 10K plus 100K. Have you ever thinking like this manner? What is this 100,000? 100,000 means the present value of this future cash flows. These future cash flows present value. At the rate discount rate 10%. If 1 year has gone and you have received 10,000, remaining 2 years, once again present value, calculate the present value at 10%. Once again 100,000. Then move on 100,000. This picture is showing that everything will perform as per accordingly, as per the contract. But the candidates, important point is that accounting standard says no. When year one start, you make entry financial asset debit bank credit with this 100,000. You have to develop an allowance of impairment loss. What should be the allowance? Allowance that you have to estimate number one, the number one credit loss means present value of expected shortfall. Means estimate that if textile industries depresses, economy down, what will be the expected defaults in the case? For example, interest will not receive, partly interest not receive, partly uh, principal not receive. Whatever the shortfalls, calculate the present value of this shortfall. And then number two, calculate the expected credit loss. Expected credit loss, if the severity is very low, that is called 12 months. If severity high, that is called lifetime. 12 months, only weighted average, WA weighted average. For example, present value of shortfall is 12,000. The weighted average 2%. The 2% of 12,000, that's only 12,000 into 0.02. That's only 240. But if in that case lifetime, then we have to report 100%. That's a higher one. But do remember that either number one, 12 months or lifetime, your amortization schedule will maintain accordingly until unless number three, actual evidence arises. Actual evidence about default. If some actual evidence arises for the defaults, then we will put for the lifetime aspect, but the interest income will not report as per amortization schedule. That will be different. That's all things mentioned here. And you can work out with this figure. That is called stage one, stage two, stage three. What is the meaning of this stage one? Number one, when initial recognition, subsequently no significant deterioration in the credit risk. Stage one means at initial recognition, you have developed some accounts, and this is based on 12 months. And interest on gross carrying amount means as per amortization, as amortization schedule. If stage two means credit risk increase. For example, if something going beyond the credit limits, that's called lifetime credit loss. But it's still lifetime credit loss based amortization based on amortization schedule. Interest income amortization schedule. But stage three will happen when objective evidence arises. Loss lifetime, but your interest will based on net of allowance amortization schedule. Candidates, I must say that we have to work out with the question. Please, the clarity of this concept is very much important for this. Please read this question once. Read this question. No need to work out. Yes, I will repeat all the things once again with this question. Please read the question once. We have a limited time, but we will work out accordingly. Please read this question. It's very challenging to recap all the important areas of the IFRS 9 in just 2.5 or 3 hours. It's very challenging, but I've tried my best to deliver as much as possible. Yes, class. What's the situation about? First January X2, Dexter Lee PLC originated 500,000 sterling loan, classified financial asset, amortized cost. Loan is fully repayable at the end of year 5. Effective interest rate 4% payable end of each year. Initial recognition. Loan low credit risk and probability default next 12 months 1% within the lifetime credit loss estimated 125,000. So first thing class, number one, please be with me. Impairment loss recognize initial recognition, adjust subsequently for change in credit risk. Initial recognition 1st January X1, loan classified at stage 1. We have report the financial asset, debit financial asset, credit bank, and debit the finance impairment loss and loss allowance credit. Based on 12 months expected credit loss, that is 1% of 125,000. This 125,000 credit loss, this 1250 expected credit loss. Can you please reply me? Is that clear, all of you? Hello, are you with me? Please reply me. That's over 1st January X2. Now moving towards next one. Now, 31st December X2, there has been no significant deterioration in credit quality, and the loan is considered low credit risk. But the probability of default increased 1.5% due to marginal increase in credit risk. Lifetime credit loss is still 125,000. So number two, we are still at 12 months credit loss, but our impairment loss become increases. And our amortized cost method is still maintained. Interest income will record in the same manner. Reporting 31st December X2, loan is still classified as stage 1. Impairment loss 625. That is 1.5% of 125,000. Why 625? Because total 1250 we have to minus. That means 125,000 into 1.5%. That's equals to 1875. That's have to 1875. 1875 minus 1250, that's equals to 625. So total allowance equal to 1875. P&L charge 625. Interest income still on the basis of amortization schedule. I hope you people are clarified. Very simple. Now next. 31st December X3. I will extend the session for 15 minutes. There has been significant deterioration for credit quality, but there is no objective evidence of impairment loss. The credit loss over remaining life estimated 50,000. Significant deterioration. That means we have moved towards the lifetime. And total estimated 50,000. Not 125,000, total 50,000. Total 1875 we have already reported. 31st December X3. We have to report 50,000 total. That's total. But we have already reported 1875. So impairment loss will increase by 4 at 175. But still 20 interest income based on amortized costs. Amortized costs. I hope that you people are with me. It's very simple. Last one. 31st December X4, evidence of the loss event and loan defaults. Actual impairment loss, 125,000. Now, still the time remains because total end with X5. Sorry, total end with X6. 2 years remaining. But 31st December X4 is classified as stage 3 objective evidence. Loss allowance total 125,000, total 50,000 already reported. Increased by 75,000. 31st December X4 interest income is same amortized cost, but subsequently at 31st December X5, subsequently interest income 31st December X5, that's net 50 minus 125, 4%, 15,000. Stage 3 interest income not based, it's not based on amortized cost, it's net basis. That is what about investment in debts in amortized cost method. Financial asset impairment. But candidates, please don't ignore financial asset impairment for trade receivable. Trade receivable is not investment in debts. Accounting standard investment in loan receivable, the financial asset impairment model for loan receivable, that we have done stage 1, 2, 3. But accounting standard says for trade receivable and lease receivable, simplified approach. Examiner can examine for this. Trade receivable, that is already you have been working since number of years, FR or F3. That's simple trade receivable. You always apply lifetime expected credit loss with trade receivable. What do you do? Allowance for doubtful debts. Have you ever applied the weighted average? No. You just calculate from the agings and calculate accordingly. So simple stage 2 normally apply. Other trade receivable means, for example, long-term receivables, lease receivables. Then you can work out for the time value of money. At that point, another simplified approach. You can choose to apply 3-stage model or stage 2 model from initial. It's an option. For example, if there is a portfolio of lease receivable in the bank, they have an option to apply 3-stage model or directly stage 2. Candidates, examiner has examined the financial asset impairment. Okay, these are the questions you have to attempt. Yes. At March 20. At March 20. At March 20. I must say, if you have any confusion about these 3 exam simulation questions, add convertible bonds, that's specimen 1 or 2, whatever I have mentioned above. That's de-recognition. And number 3, the financial asset impairment humming. You have to simulate before tomorrow class. You have to work out accordingly. All exam simulate. Will you do that? Yes or no? Will you do that? Jazakallah khair. That is your assignment. You can ask me on the WhatsApp. You can ask me here even. Do it wrong, no matter it is, but attempt it. That's important. That's a key point. That is the key point. Candidates, another point is the accounting. But what I personally think that this is not the right time for discussing the hedge accounting matter. I will provide you 15 minutes lecture for the hedge accounting. I'm not promising you, but if I have some spare time for the hedge accounting, I will share you something, but tomorrow or any next session or with any question. But these notes are very good. You can read it accordingly. It depends. So you have to work out accordingly, but whatever the maximum we can done, we have done accordingly. Inshallah, the tomorrow session that I will conduct about IFRS 15 and IS 12 matter. IFRS 15 and IS 12 matter. And I strongly suggest for you people that I will connect with the group accounts definitely for these sessions. I will discuss tomorrow the IFRS 15, IS 12 and ethics matters. Connect with the ethics. Some multi question with ethics. some multi question with ethics. And if you people have any issues related to this IFRS 9 questions, I will apply accordingly. Otherwise, I have a plan that uh, tomorrow the integration of the questions with the ethics, deferred tax, IFRS 16. Candidates for group accounts, I must say to you that you must have to watch my first 2 days videos of December 20 session. I will share the complete material of December 20 P2P on the WhatsApp group immediate after the session. Don't worry. But for the group accounts, I have given a complete other than foreign subsidy, and the cash flow. I have delivered a comprehensive lecture on the group accounts last December P2P. You can watch my video. You at that from that particular video, you will cover a lot of things. I will share all the links and the document material as well. Yesterday recording already available. I have already shared on the WhatsApp group. I have shared the link of the WhatsApp group, including G Drive, where you can collect the material as well. What I say to you that, just a minute, just a minute. Just a minute. I'm going to share right now. I'm sharing you complete Vimeo videos plus the documents folder with you people on the WhatsApp group. Yes. Of December 2020 on the WhatsApp group. Yes, I have shared. Now start watching day 1, day 2. That's a group accounts material. With this P2P, I will discuss the group accounts material that I have not covered or that was not important for December 20. Now March 21, the important part I will discuss with the some part day 4 and the complete part of the day 5. ACCA management, can you please share the WhatsApp group link once again to the students? Thank you very much. Thank you very much. Yes, theme of the topic will remain same. The remaining part of the group I will share. I, because you have to cover everything now. Lilia, you have to cover everything. So that's why first phase of the, you can consider that first phase of the group. That's you can pick from the December P2P, and second phase of the group, that's the some part day 4, some part day 5. Hafiz Mubashir Sahab, Just remember me in your prayers. Yes, I will cover some part, a quick summary of the IFRS 15. A quick summary. Can you please provide me a quick feedback of the today's session and the total session day one, day two? Is this session valuable for you? Is this session valuable for you? Inshallah, on tomorrow, we will discuss more exam question where marking scheme insights will also cover accordingly. Four and five above. Okay, day one, day two. Please don't ask this question, which standard has a chance to come at March attempt. If this knows to us, then we will become the billionaire. And this is not the honest way to cover the syllabus. Examiner will ask majority of the answers. So you don't need to focus just cherry picking. Focus complete syllabus and appropriate preparation and give your honest efforts. Let's see about the share-based payment. Let's see. Yes, first two about the group accounts. Okay, candidates, thank you very much. Take care a lot. I will upload uh, the documents on the document folder as well. Don't worry. Jazakallah khair. Assalamu alaikum. ACCA management, can you please share me one more time the SBR WhatsApp group link? I will highly oblige. Thank you very much. Thank you very much. Jazakallah khair. Assalamu alaikum.